Today, is it time to go into reverse? Hello again, it's Martin North from Digital Finance Analytics. Welcome to the latest posts covering finance and property news with a distinctively Australian flavour. And today I'm joined again by Steve from Canstar. Hi Steve.
G'day, Martin.
How are you?
I'm terrific, thank you.
Great, well thanks very much for spending some time. And today I want to do two things. Get a quick update on rates, going down I'm sure. But then I want to touch on reverse mortgages because I think this is a conversation that we need to be talking about.
Yeah, it is a conversation worth talking about, and it's a product that a lot of people, I think, have a real need for, albeit there are risks. So we'll certainly cover off on that.
Excellent. Well, let's just touch on rates. More ultra low rates being offered at the moment.
Oh, gee, they are. I mean, they keep going south, don't they? I mean, 1.75, 1.69. I mean, that's quite remarkable. You think, well, where's it going to stop? Now, I'm thinking it will probably stop. At least for most lenders pretty soon, but there'll be argy-bargy at the very bottom end. So I think, you'll get the odd loan here and there that might be down below where they are today, but gee, it's hard to see that mainstream lenders can really afford the loss of margin on a big part of their book. So I think, there'll be niche little loans provided there, but I can't see it going a whole lot further for the mainstream of borrowing.
Well, it's interesting looking at the results that have come through this last quarter. The margins sort of wobbled up, wobbled down, depending on which you looked at. The real reason that the profitability improved was they've taken down their bad and doubtful debt provisions because things were not as bad as perhaps they expected. But that would suggest that their ability to be able to continue to take rates lower is now getting to the point where it's going to get harder and harder to do. So, sideways and then maybe up.
Yeah, look, it's interesting. CommBank's result the other day showed that margins are struggling, and
Yep.
Right, they all over-provided for the first half of 2020, thinking that it was going to be worse than it's turned out to be. Now there still could be losses, of course, but it looks like they have over-provided at this stage, which is good for their balance sheet, there's no question. Yeah, the margins are very, very tight, so it's hard to see much more happening. And don't forget that term funding facility runs off sometime around mid-year, probably before the end of June, I'd say. I think that will hurt a bit. That's a very generous, 10 basis point rate. Now, they won't replace that. And so I think, frankly, we will see a little bit of upward movement in some of those fixed rates around that period. Now, not a huge increase, but a small one.
Well, my sense is, and this isn't financial advice, but some of the 5-year fixed rates that are there at the moment look remarkable and probably will be pretty much, as low as they will ever go. So if you want security and certainty, those fixed rates look quite interesting.
Yeah, I think that's right. I mean, everyone's situation is different and people have to worry about, well, will I want to repay it earlier and all that sort of stuff. But you look at where we are on the cycle, and if you go 3 years or 2 years, you're probably going to have to fix again, and you might not get as low as you are at today. Whereas 4 or 5 years, I mean, remember, 4 or 5 years, two of the big banks are in there at 1.99%. If you go up 4 years, you'll still have a couple of nice, handy years when rates have probably bottomed and are moving up again. So it's not a bad time.
Absolutely. Well, it's interesting because I often say that people quite often go into fixed rates precisely at the wrong time in the cycle, right? And then miss out when it's the right time because it's quite difficult sometimes to pick when to do it. But it looks as though the indicators are pointing in the right direction at the moment.
Yeah, it's all the psychology is the problem. I mean, people at this stage are saying, "Oh, they might go lower. I better hold out," and then they hold out and rates are going up and up and up and up. And people then say, they wait until the pain of all the increases is just so intolerable that they say, I've got to fix, I can't go through any more of this. And of course, they're picking almost the exact inflection point where they start falling again.
Yeah, spot on. And I always think that fixed rates are about it's like an insurance policy, right? At least you know where you are, and you can't be hit over the head with a nasty surprise, and you know precisely where you're going to be heading for the next little while. And okay, you might miss out on a little bit of very short-term downward momentum, but where we are, there isn't a lot of downward force coming, I think, ahead.
Yeah, which means also that if you do have to get out earlier, you're not going to be up for a massive economic cost as well. So, I mean, it's not a bad time all around. You're right, though. I mean, if you could pick the bottom and top of markets, you wouldn't be worrying about working for a living. You'd just be buying stocks and buying commodities and doing interest rate trading and all those things. And it'd be easy. No one's that good at it. Even the professionals aren't that great at it. So yeah, it's don't wait for the bottom. Do it when it sounds kind of right, and think about the surety of your repayments. That's really what you're worrying about. Affordability. Do I want to shock and have to pay another $100 or $200 in a year or so's time?
Well, predictability, I think, is a big thing. And talking of predictability, the other big deal, as we've discussed on many occasions, is that deposit rates are ever so low. Many people, as they move into those sort of later years, have a property, sometimes with a mortgage, sometimes without a mortgage. They may have some savings in the markets or indeed, in deposits. But they're looking now at this rather awkward situation where they might be asset rich, but actually cash flow poor because they're just not getting the returns. And this begs the question now, what are the right strategies to think about in that situation?
Yeah, I mean, you're right. There is a whole generation of people called baby boomers who are probably in this category because they've owned their properties, their houses, for 50 years, and they've watched this nice, steady and predictable inflation of their house prices, and yet they don't have income to live off, and they're on pensions. So they are very much the target group for reverse mortgages, which releases some of the value that's in their property, and they put that towards their living.
Now, reverse mortgages a few years ago got a really bad rap from ASIC, right? They basically criticised the way that they were being sold. They cited examples where people were effectively forced to move out of their property unexpectedly because they'd run out of runway, as it were, and all of those things. And even the way that they worked was not necessarily that well explained to people getting into them. Things have changed a bit, but maybe not a lot.
I think things have changed a lot because government stepped in and said, look, one, you can't run out of runway anymore. You can get to the point where you don't own any of the runway, but you won't run out. So if you are alive and well enough to live in your own home, you won't be thrown out. Even if you are in negative equity, so the loan's bigger than the value of the property, you still won't be thrown out. You won't owe anything more than the value of the property. When you die, the property will be sold and pay off the loan, but your successors won't be up for any shortfall. Now, that's made a massive difference to the product because it takes a lot of the risk out of it for people. And it's a big improvement. And the other reform was that there was insistence that people had to really lenders had to really understand the situation of the borrower and suggest advice to the borrower before they went into it, because there were a lot of people who were making an emotional and short-term decision that really wasn't right for them longer term and further down the track. Now, fortunately, those two things have made a big difference to the product.
Right. And just to recap on what a reverse mortgage is, basically it's getting an income out of your property on a sort of monthly or quarterly or whatever basis, right? And essentially eating out of the equity that's in the property, converting it into a flow of funds. Often that will be linked to the bond rate, which gives you a little bit of a sense of, how much you can and can't expect perhaps to receive. But for many people, it can be a lifeline because it is potentially an extra source of cash flow, which is what they need in their later years.
Yeah, they do, and self-funded retirees often do have a pretty substantial property there. $1 million worth of property, and if you got $1 million worth of property, these can be a viable option. So it does release that equity, and you can take it actually as a lump sum as well. For say a home reno or a holiday or something. So you can take it as a lump sum or as a regular supplement to living, but some of those people are retiring on very modest incomes, and they want to enjoy the lifestyle, and they want to stay in their house. That's the important thing. They don't want to trigger capital gains tax by selling the house. That's money just down the drain. They don't want to leave the house. It's their lifestyle. That's where they're comfortable. So they can stay in their house. They can supplement their living and have a more enjoyable and comfortable retirement. And it sort of sounds like nirvana. It sounds like, well, nothing can go wrong. But of course, stuff can go wrong.
Well, let's unpack the stuff that can go wrong, right? And I guess there are a few things there. Firstly, you may find you have to at some stage move from your own home into sheltered accommodation, right? And that can create a trigger event which can create a problem.
Yeah, look, that's actually, in my view, that's the major risk with this product. The risk is, as you say, you might have to move into a high care facility, a nursing home. And at that point, if you want to choose your nursing home, you want to choose where you go, you want some control over your destiny here, you have to pay a bond. And what happens is that people generally sell the house, pay the bond, put the rest into a term deposit, and everyone's happy. But when you have a loan out against the property, and a loan that's increased over the years, and we'll talk about that in a minute, you will find potentially that the loan's too big, the property value hasn't gone up enough to keep pace with the loan, your equity's gone down, the nursing home bond has gone up with inflation, and you can't afford anymore to pay the bond for the nursing home of your choice. You've got to go into a state facility that might be somewhere that doesn't suit you and might not be as comfortable, as nice as the one that you choose. So that's, I think, the biggest risk with this product is that people can and a lot will eventually find themselves in that situation and really feel, look, gee, I wish I thought of all that before I made this call.
And it's hard sometimes trying to think ahead and look ahead because, the future is uncertain. And it's worth reflecting on the fact that, average life expectancy in Australia is quite long, so, 70s, 80s, 90s, is not unusual.
Yeah, look, I actually looked at this, quite a while ago. I dug out the spreadsheet for it, and I'm going to look at it really quickly now. And I used an inflation rate of 3%. Well, we're 0.9% now, and I used a mortgage rate, a reverse mortgage rate of 5%. Well, they're of 8%. They're about 5.6 now. But what it shows is that after 10 years. And also the nursing. And I used an inflation rate for the property of 3%, an inflation rate for the nursing home bond of 3%. Now, after 10 years, it looks as if your equity is probably enough to cover the bond with all those assumptions. But after 15 years, you're line ball. Now, it doesn't take much for one of those to fall out of kilter and you're behind the eight ball. So if the nursing home bond goes up by a lot more than inflation, you're behind the eight ball. If the actual interest rate sort of outstrips the inflation rate by a bigger margin, you're underwater. The only saving possibility in all of that is that the property value will go up faster than inflation. And that's probably a fair reflection of recent history. But we don't know that that's going to happen in the future. But that's what you're betting on if you go into one of these.
Yeah, and it's worth just reflecting on this compounding, right? Because when you're saving, compounding actually works for you because you get interest on interest, which means that the value increases. But the reverse is also true with the reverse mortgage, right? They're going to charge you interest on the loan that's outstanding. So as the loan outstanding gets bigger, the interest on interest gets bigger.
Yeah, well, just to give people an example, this was a really rough little spreadsheet, so I was right. This $140,000 loan today at 8% becomes a $302,000 loan in 10 years' time. Now, we're not at 8% at the moment, but it doesn't take much of an imagination to see when we will get to 8% again, because we're talking long term here. So it's doubled in 10 years, the loan. Now, that's what happens with compounding when you're not making repayments. And that's the whole principle of reverse mortgage. You can live off the money without having to worry about repayments until you actually move out of the house.
So I guess takes us to an important question: is, age-wise, when might this make sense? Because clearly there is an age, below which it probably makes no sense at all because of the risks we've been talking about.
Yeah, look, 65 looks pretty dangerous because at 65 years you've got 20 years of life expectancy if you're a male, and you won't be able to afford the nursing home bond on a $700,000 house where you borrow 140. So that's kind of the reality. Now it's not quite true because inflation might, house prices might go. They might bump right through the roof, and that's, who knows. But that is the risk you run, and it reflects in the way the lenders do this too. Because if you're a 65-year-old, you can only borrow 15, 20% or something, yes. And have a guess when 45% of the maximum cuts in. Have a guess.
Somewhat older.
Somewhat older, 85. Yes. So if you're 85 and you need to borrow one of these things, well, gee, you're probably a pretty active 85, I'd say.
Absolutely. I guess the other philosophical point here is, intergenerational stuff's quite important because, of course, quite often the family will assume that the value from the family house, and indeed maybe the value from some of the other savings, is actually there for, when ultimately death comes, it passes down the generation, right? This, of course, means that there is less to pass down.
Yeah, of course it does, and that's one of the big issues with it as well. Now, to me, I think it's a secondary one to the nursing home care later on in life, but it's still an issue, and it's inescapable. I mean, if you've got to say, well, look, the people who've earn the lifestyle should enjoy a lifestyle, and hopefully they'll be leaving something. But people do aspire to leave more than just a little bit, and that's where it could end up. It could end up that half, 2/3, could be even more of the value of the property is no longer available to go to your successors. It's why when you're considering one of these deals, not only should you get advice from your standpoint, but you get it from the standpoint of your children, your offspring, and you also sit down with them and explain what you're doing, why you're doing it, and the repercussion that can exist. Now, I would hope that most offspring would have sensitivity to your lifestyle as being number one in this, but you've got to make sure that it's understood.
Absolutely, because there can be a lot of pressure put, I think, on particularly older people by some members of the family in some situation. In fact, I've tripped over a few of them through my conversations with individuals. So that's something to bear in mind. The other thing to bear in mind is what are the tax implications? So if you are actually generating income from effectively a reverse mortgage, that is counted as real income, isn't it?
Oh, absolutely, yeah. And I mean, also though, there are tax situations implications if you just sell your property up front.
Yes.
So capital gains tax, and then you've got the income, so you don't qualify for as much pension, et cetera, et cetera, et cetera. So either way, there are plenty of things to think about, and tax is a big deal. Eligibility for pensions a big deal. Now that's why. So they do give this option for lump sum or regular drawdown. Regular drawdown is less likely to trigger big tax implications because you draw it down and you live off it. Even if you take a lump sum, if you're doing renovations, then they're gone. That's gone as well. So again, not as big an implication. But if you'd have to take a lump sum drawdown, sit it in a bank account, and then draw on that bank account, that's probably going to hurt you in terms of tax, hurt you in terms of pension eligibility. So you need advice on that as well. It's why I'd say to people, look, don't just rely upon what the rallies say. Don't just rely upon what I say. Go and get proper financial advice on just this aspect. You don't have to get sort of a full-on financial advice on all your investments and everything, but get proper advice on this from someone who understands the tax law, the pension laws, but also how compounding works. It's a mystery to a lot of people, but that's one of the real biggies, of course.
And the final thing to talk about is if you are in a relationship, you're a married couple, right? There's also an important question here as to what happens if one party dies.
Yeah. Normally, if look, there is because of all sorts of relationships and second relationships, etc. Because people outlive one another and then go and live with someone else, etc. And the real problem arises where if there are two parties, joint owners, joint loan, then death would normally mean death of one party would mean nothing changes. The surviving party can continue to live in the house. Where there's a relationship that's developed where the property's not in both names, the loan's not in both names, and the person who dies is the property owner, well, the survivor, who could be a partner of 15, 20 years or something, might find that they're out of the house. Now, that's not a great outcome for anybody, but I think in a legal sense, that's where it would end up. Now, I'm not sure how sensitive they are to that sort of arrangement or not, but that's sort of the realities of it. So that's really awkward. And the other awkward thing is that even if there are two surviving parties and both of them end up having to go into a nursing home, then that's two bonds. And if you can't afford two bonds, well, maybe the two partners will end up in different facilities, which is far from ideal.
Yeah, or the situation where one party needs to go into care and doesn't have enough money for that, and yet the other one wants to stay in the house. Those sorts of complex problems do arise and can arise.
Yeah, they absolutely do, and it's why people need a lot of advice at the outset here, because you're not actually people understand the immediate problem they're trying to solve. They say, I need another $20,000 a year to enjoy my lifestyle. They get that. What they don't understand, what they can't foresee are the outcomes way down the track. And, we're talking, maybe 10 years, maybe 20 years down the track for some of these outcomes to become a reality. People aren't very good at envisaging that. The immediacy of it is what dominates their thinking. So get advice and think about those scenarios. And if the advice doesn't encompass all those scenarios about nursing homes and when people die, et cetera, make sure that you find another advisor.
Yeah, and I think the key point there, Steve, is that not the people who might be selling the product aren't probably the best people to give the advice.
Yeah. I think I agree with that. Well, I know I agree with that, because you need somebody that has a full skill set on what happens in life, what happens with tax and pensions, and is independent of the decision to buy or not buy that product. Don't just rely upon the salesperson.
So folks, if you are going to consider this, go careful, get advice, think about all the issues that we've been talking about today. But of all the issues, Steve, the one that you think's the most critical one is?
Oh, look, I still think it's going into nursing homes, but it's understanding compounding as well, because they're related, frankly. Now, this sounds, we've been talking about the negatives for a while. I actually support the product, but the product only works for the right people. And if your property's not worth a whole lot compared to what you're borrowing, there's a very real chance that you will trigger some of these difficulties. If you have quite a valuable property, then the chances are you'll be fine, because there'll be enough equity now. The equity will continue to grow, and you'll still be left with a fair margin for these eventualities. So I think it still works for a lot of people. But if you're in just a marginal property, you're opening yourself up to these future difficulties.
And I'd add that to one other thing, and that is, don't do it too young. Right? This is something that really works later in life rather than earlier in life.
Yeah, look, I agree with that, and it's borne out by the amount that the lenders are prepared to lend on it, because they understand those compounding tables and how quickly a debt doubles. And I've shown 10 years at an 8% rate, so it doesn't take a long time before you really are starting to trigger an event of eroding your wealth and your equity.
Absolutely, and I'm with you, Steve. I think there is a room for this product. I think that what the government did was useful in terms of making it more safe for people to consider. But it is one that you mustn't jump into. You must go through these deliberations. And, if it fits, go for it. But just be cautious of some of the things we've been talking about.
Yeah, exactly. I mean, I hate to see people move into a product they don't understand. And this one comes with risks that are not easily reversed. And that's even worse because, you've gone down this path. Now, unless you've got a wealthy uncle to pay it out at some point, it's hard to reverse this decision. And so if people, if they go into a complex product like this, they've got to go in eyes wide open and understanding the risks and then understanding where they fit in that landscape.
Absolutely, Steve. Well, I appreciate your time today. I think that's been a really important and, frankly, hopefully informative, but at least alerting conversation, because I think there's a bunch of questions for people there. But as we say, there is an opportunity for the right people at the right time through their life cycle.
Yep, I agree totally. The issue is that there's a whole generation who are retiring and have retired, who are asset rich and cash poor. And if you're asset rich enough, this can be quite the solution.
Great. Steve, thanks for your time today. I really appreciate it.
Pleasure, Martin. Enjoyed it.
Thank you. Take care.